Those are Maruti's earnings that we are getting in. The standalone revenue has come just in line with our estimates at a little over 29,000, which means it's a 44%, nearby 44% rise on a year-on-year basis. The standalone net profit as well is looking good at about 2,700 odd crores, which is again bang in line with what we had expected. So it was supposed to be a strong showing this time around because of a low base and also a demand recovery that we have seen. Again, very strong volume growth we had seen in the second quarter as well. Volumes had to rise YOY and QOQ. So on all these parameters, it looks like the numbers have come bang in line with what we were expecting. It was supposed to be a strong quarter, and that is exactly what the company has delivered. 2769 crores in terms of the EBITDA as well is looking very, very good. Sonia is here with us. Sonia, are you happy?
Oh, this is a good set of numbers. I mean, it's largely in line with expectations, right? There are no real surprises. The margins were expected to improve. The poll was about 9.3% and the margins have come in at 9.2%. A good improvement on a year-on-year as well as on a quarter-on-quarter basis for Maruti. Now, from the press release, I'm just reading about the positive factors that led to this margin jump. One is better capacity utilization, a favorable foreign exchange variation. So there was a depreciation of the yen, and about 7 to 8% of the imports for Maruti are yen-denominated imports. Hence, the depreciation of the yen aided them in that sense. Apart from that, the company has said that they have taken certain cost reduction initiatives, and that has resulted in a better performance for them on the operational front. There's also the softening of commodity prices as well as a higher non-operating income that has aided to Maruti's numbers this time around. A couple of negative factors, actually just one that they've mentioned: higher advertising expenses. This is because of the slew of new launches that Maruti has had, especially on the SUV front, because of which they've had to incur higher advertising expenses. But if you look at the key reason for the improvement in margins is that there has been a significant fall in their material costs. So raw material costs for them as a percentage of net sales has gone down 160 basis points compared to Q1. Now material cost is just 76% of their net sales compared to 78% last quarter. So that's the key reason why the margin performance has improved for Maruti. The employee costs have also gone down as a percentage of sales, but that's not much. I mean, it's 4% of their total sales compared to 4.6% last quarter. So the fall in material costs is the big reason for the improvement in their numbers. Sales volumes, of course, have done very well. That's because, you know, as Sumera was pointing out, it's a low base, as well as there was a lot of inventory stocking done ahead of the festive season at the dealer's end. Hence, the wholesale numbers looked much better. The key now for Maruti is to see how the new launches are faring, because they have a slew of new launches that are lined up over the next 12 months, especially in the SUV segment. They have a new WagonR electric coming out as well. They have the Jimny, they have the new Bolero. So all of that, how does it really bode well with customers? And do they really penetrate the SUV segment? Those are some big questions. The management will be, of course, addressing the media very soon. But these are a good set of numbers. Strong volume growth is what we've seen. A good operational performance led by fallen raw material prices, the price hikes that the company undertook last quarter as well, and no complaints at all as far as Maruti is concerned.
Okay, Sonia, thanks very much for that. In fact, I think we have a couple of experts who are joining in. Prakash Diwan is with us. Hi, Prakash. I don't know if you heard Sonia reading out the numbers, but along expected lines, it's a strong showing by Maruti. Are you surprised that there are no surprises?
Sure, I like the way you put it. But, you know, what's interesting about a normal set of numbers is that they've kind of digested all the issues related to raw material price hikes, which, of course, were accentuated in Q1. But that seems to be now way behind us. And also, interestingly, you know, the kind of demand profile that they are handling, to be able to, you know, augment supply with such limited constraints on the chips, shortage issues and all of that, I think they've done a commendable job. So I think the key metrics now which will keep on driving the stock further in terms of an upside is more of realization going up, the higher ticket premium vehicles being sold in the product mix, and them regaining market share. So I think these 2-3 critical things. Of course, we'll wait for the management's views on all of this, but I think those are going to be very heartening to hear from them after this set of numbers.
Okay, the management also says that the pending customer orders stand at 412,000 vehicles at the end of this quarter, out of which 130,000 vehicle pre-bookings are for recently launched models. So they're sitting on a huge pending order of over 412,000 vehicles, and that just goes to show that even the way forward will look pretty good. But Prakash, I wanted your thoughts on whether Maruti can get to double-digit margins in this fiscal itself, because their raw material cost as a percentage of sales has fallen significantly. On a year-on-year basis, it's down 390 basis points. And the indication is that there could be some more, benefits because of the falling RM prices. So what are you penciling in terms of earnings in the second half? Are you raising your earnings estimates, and hence would you raise your target price as well?
So, very, very important point that you raised, Ludiam, because not just the raw material price reduction that I talked about as compared to quarter one, but their ability to be able to pass on higher prices with these new bookings. Remember, when you go out to book, the variants that are getting booked and which will get delivered are going to be the higher end ones. So from that perspective, realization is going to be a very key margin trigger for them. I wouldn't be surprised if they actually end up getting into the early teens by Q4, because you'll have a lull again coming through in terms of Q4 numbers, but in terms of demand, at least Q3, Q4 can be a bit big beyond the festive season. But Q4 is where probably the margins do make a potential comeback. And on the stock, I think the way it's consolidated so healthily at those 86, 8700 zones and then moved up strongly, my sense is we'll probably see very new orbits for this as the supply constraints get eased out and actual sales happen, the realization starts happening. So definitely it's ripe for a decent upside of at least 12 to 15% over the next 12 months, 6 to 12 months. But there could be some pleasant surprises as well along the way.
Okay, in fact, the stock is not too far away from its 52-week high. The 52-week high that it hit was 94.50. This was on 23rd of September this year. And the stock is now at 92.35. So it's very close to its 52-week high. Even if you look at the margin trajectory, right? I mean, this is a multi-quarter high as far as margins are concerned for Maruti. So just want to get a sense from you. I mean, the last time when we saw these 9% margins, in Q4 of FY22, of course, they did 9.1%. But before that, for a very long time, they were stuck in this range of around 5 to 8%. When do you think they can get back to double-digit margins, Prakash? And is the risk-reward still favorable now for the stock?
Oh, absolutely. So, let me first take the risk-reward part, answer that question first. Because right now, as I said, all the consolidation that the stock would have witnessed at sub 9,000 levels is done with. And you only have, improvements happening on all metrics, whether it's revenue, whether it's margins, whether it's, raw material price reduction, or eventually some new model launch which could change the trajectory at all. I think they're constrained because of the chip shortage. Otherwise, they would have already launched the Jimny, which is, in my view, a potential blockbuster because the gap it fills is unique. There's nobody else in that space, and they can actually kill the competition before it even comes up. So that's the kind of strength they have. So people will start seeing all of that come into the price. And that's exactly why your 52-week high will definitely get breached. The risk reward is certainly favorable. On the margins front, Sonia, I think the Q4 of FY23 is going to be the most critical. Whether they are able to supply high-end models, as I said, the product mix gets finer or refined as they go along. The waiting period is an advantage for them, but they need to deliver fast. Otherwise, people tend to be very fickle about bookings, and then people decide to move on to other models and other suppliers. So there's always an issue of that. If they can cater to this pent-up demand of 4 lakh plus vehicles that are booked with higher-end products, I think then they're home on that double-digit margin profile.
Okay, Prakash, thanks a lot for that. In fact, these are the highest margins that Maruti has reported since Q3 of FY21. So that means it's a 7-quarter high that Maruti is sitting on in terms of margins, and it's purely because raw material costs have come off. The management has also said that there are cost reduction efforts that they have undertaken, because of which the margins have improved. So good set of numbers coming through for Maruti, largely in line with expectations. So no major positive or negative surprise, but the good part is that volumes are picking up because demand has come back, and there is operational benefits as well. The stock, by the way, is not too far away from its 52-week high. Sumaira, back to you.
All right, Sonia, thanks for taking us through the numbers. We're going to take a very quick break, but we have our two experts waiting by to answer all your stock queries. We'll get to them on the other side. Stay tuned.